Consider the profound paradox embedded within the modern retirement infrastructure. The concept of a state-sanctioned retirement age was not born out of a benevolent desire to reward decades of labor with a golden era of leisure. Rather, it was a geopolitical calculation engineered in 1889 by German Chancellor Otto von Bismarck. Facing the twin threats of rampant youth unemployment and rising socialist unrest, Bismarck instituted a pension program that paid citizens to voluntarily leave the workforce. The statutory age of retirement was initially set at 70, a figure that was later reduced to 65 during the First World War. The profound irony of this legislation lies in the actuarial demographics of the late 19th century. The average global life expectancy at the time was approximately 42.5 to 45 years. Chancellor von Bismarck effectively invented a system designed mathematically to outlive the vast majority of its participants. He was not conceptualizing the modern golden years. He was executing a fiscal maneuver to keep political rivals at bay and pacify the labor force. By the time the United States introduced the Social Security Act in 1935, amid the devastating unemployment of the Great Depression, the age had been anchored at 65, establishing a societal expectation that most individuals would labor for the entirety of their viable biological lives. Today, the global economy is experiencing a radical demographic inversion. The United States has entered the peak 65 zone, representing the largest surge of retirees in the nation's history, with an estimated 11,200 people turning 65 every single day between 2024 and 2027. Simultaneously, an expanding demographic of workers is attempting to reverse engineer Bismarck's centuries-old paradigm. Operating under frameworks often associated with the financial independence, retire early, FIRE movement, these individuals seek to exit the workforce 2 to 3 decades before traditional pension systems initiate payouts. The objective of this analysis is to demonstrate that retiring decades early is not a function of rudimentary frugality or basic savings heuristics. It is an exercise in applied macroeconomic theory, actuarial mathematics, and systemic risk mitigation. By the conclusion of this video, the viewer will understand the hidden mechanics of human capital conversion, the institutional strategies utilized to circumvent sequence of returns risk, the arcane tax code arbitrage used to unlock illiquid assets, and the profound macroeconomic ripple effects that occur when a critical mass of the population structurally withdraws its labor from the global economy. To deconstruct the mechanics of early retirement, one must first establish the core economic definitions at play. The foundation of wealth accumulation begins with human capital. In economic theory, human capital represents the present value of all future wage earnings an individual is expected to generate over their lifetime. For a young individual, human capital is by far the largest asset on their balance sheet, vastly outstripping early financial savings. The process of achieving financial independence is, mechanistically, the accelerated conversion of human capital into financial capital. By maintaining aggressive savings rates, often scaling between 50% and 75% of gross income, individuals force an early capitalization of their lifetime earning potential, redirecting cash flows into diversified asset classes designed to generate passive yields. However, the transition from the accumulation phase, working, to the decumulation phase, retirement, introduces the most critical vulnerability in modern portfolio theory: sequence of returns risk, frequently abbreviated as SORR. Imagine a portfolio as a vast reservoir of water that must simultaneously sustain agricultural outflows, representing living expenses, while being replenished by rainfall, representing investment returns. If a severe drought, akin to a market crash, occurs precisely when the largest initial outflows begin, the reservoir's volume shrinks so drastically that subsequent rainfall cannot restore its original water level. This is the essence of sequence of returns risk. In a traditional accumulation phase, the chronological order of investment returns is mathematically irrelevant to the final balance, provided no capital is withdrawn. A sequence of minus 20% followed by plus 20% yields the exact same final balance as plus 20% followed by minus 20%. However, once regular withdrawals commence, the sequence becomes paramount. Regular withdrawals progressively diminish the portfolio's absolute dollar value, which serves as the base upon which future compounding occurs. Consider the precise mathematics of sequence risk on a decumulating asset base. If an investor holds a $1 million portfolio and experiences a 20% decline in the first year of retirement, the principal balance falls to $800,000. If that investor requires $40,000 for annual living expenses, the required withdrawal now represents 5% of the remaining portfolio, rather than the originally planned 4%. To fund this distribution, the investor is forced to liquidate a substantially larger volume of shares at depressed market valuations. These liquidated assets are permanently removed from the portfolio. They cannot participate in the eventual market recovery, creating a permanent drag on the portfolio's regenerative capacity. The profound impact of this timing can be illustrated through a hypothetical comparison of two identical portfolios, experiencing the exact same average return over a 5-year period, but in a precisely reversed chronological sequence. Despite identical arithmetic averages over the measured time frame, the portfolio suffering early negative returns experiences accelerated depletion, concluding the period with a deficit of $110,000 relative to its counterpart. This discrepancy is solely attributable to the sequence of returns. For an individual retiring at age 40, facing a potential 50-year decumulation horizon, a negative sequence in the first decade is not merely inconvenient. It possesses the mathematical potential to be fatal to the entire financial plan. Escaping this fate requires mechanisms far more robust than simple asset allocation. Understanding the foundational risk is merely the diagnostic phase of the equation. The cure lies in the unseen engine of early retirement, a confluence of dynamic withdrawal frameworks, institutional asset management principles, and complex tax code arbitrage. The architecture of early retirement is heavily reliant on the concept of the safe withdrawal rate, SWR. In 1994, financial planner William Bengen established the canonical 4% rule, demonstrating through historical market conditions that a portfolio could survive a 30-year retirement without depletion if the initial withdrawal was limited to 4% of the starting balance, with subsequent withdrawals adjusted annually for inflation. However, applying a 30-year heuristic to a 50-year early retirement horizon exposes severe structural flaws. Prominent economic researchers argue that early retirees, facing potentially 5 decades or more of capital decumulation, must utilize significantly more conservative withdrawal rates, often calibrated between 3.25% and 3.5%. More importantly, safe withdrawal rates are not anchored to historical average returns. They are heavily dictated by macroeconomic valuations at the exact moment of retirement. The most predictive metric for long-term safe withdrawal rates is the cyclically adjusted price-to-earnings, CAPE ratio, famously developed by Nobel laureate Robert Shiller. The CAPE 10 ratio measures stock market valuation by averaging earnings over a trailing 10-year period, effectively smoothing out short-term cyclical fluctuations. When CAPE ratios are exceedingly high, such as entering 2024 with a Shiller KP exceeding 32, the inverse of the ratio, the earnings yield, forecasts substantially lower real returns over the subsequent decades. In environments of elevated valuations, the forecasted real return on equities may drop to approximately 3%, less than half the historical long-term average. If an individual retires into an environment characterized by historically high equity valuations and suppressed fixed income yields, the probability of enduring a multi-decade period of low real returns increases exponentially. Consequently, static withdrawal models like the 4% rule become dangerously rigid, as they mandate consistent capital outflows regardless of underlying asset pricing. To combat the inherent rigidity of static withdrawal rates, advanced economic planners utilize dynamic spending models. The most prominent of these frameworks is the Guyton-Klinger guardrail method, expanded in 2006 by Jonathan Guyton and William Klinger. Rather than adhering blindly to an inflation-adjusted floor, this framework treats retirement spending as a dynamic variable governed by strict algorithmic decision rules designed to protect the longevity of the portfolio. The Guyton-Klinger method posits that retirees can safely elevate their initial withdrawal rate to between 5.2% and 5.6% by legally committing to systematic spending flexibility. This mechanism relies on 5 interconnected guardrails. First, the portfolio management rule dictates the exact source of each year's withdrawal to enforce continuous rebalancing. Withdrawals are funded sequentially, first from overweighted equity asset classes from the prior year, followed by overweighted fixed income, then cash, and finally remaining assets. Crucially, this rule mandates that no withdrawals are taken from any equity asset following a year with a negative return, provided cash or fixed income assets are sufficient to cover the outflow. Second, the inflation rule establishes that yearly withdrawals normally increase by the annual rate of inflation, measured by the CPI, but caps this maximum annual increase at 6% to prevent inflationary spikes from rapidly draining the portfolio. Third, the withdrawal rule acts as an immediate freeze. Following any year where the portfolio's total investment return is negative, the retiree is prohibited from taking an inflationary increase. Furthermore, there is no makeup allowed in subsequent years for this missed increase. Fourth, the capital preservation rule serves as the lower financial guardrail. If adverse market conditions cause the current year's withdrawal rate to rise more than 20% above the initial rate, for example, if a 5% initial rate spikes to 6% due to severe portfolio depletion, the retiree is mandated to take a permanent 10% reduction in their absolute spending. Research indicates that a series of these small but permanent cuts is mathematically superior to large temporary adjustments. Fifth, the prosperity rule serves as the upper guardrail. If massive bull markets cause the current withdrawal rate to drop 20% below the initial rate, the retiree is granted a 10% increase in spending. This allows the retiree to participate in economic booms and offsets the purchasing power losses incurred during freeze years. Complementing these guardrails is Michael Kitch's ratcheting rule, a one-directional flexibility model introduced to address the psychological tendency of retirees to underspend due to the fear of asset depletion. Because safe withdrawal methodologies are inherently conservative, designed to survive the worst-case historical scenarios, retirees frequently finish their lives with more than double their starting wealth. The ratcheting mechanism dictates that if a portfolio's account balance ever grows 50% above its initial starting value, the portfolio is mathematically far enough ahead to sustain higher spending. At this threshold, the retiree permanently increases their spending floor by 10%. Furthermore, research by Wade Pfau challenges conventional asset allocation dogma during the decumulation phase. Traditional financial advice suggests decreasing equity exposure as one ages to minimize volatility. However, the rising equity glide path proves mathematically superior for mitigating sequence risk in early retirees. By entering retirement with a highly conservative allocation, such as 30% to 40% equities, to suppress sequence of returns risk during the most vulnerable initial years, and intentionally allowing the equity allocation to drift upward as fixed income assets are spent down, the portfolio creates an organic hedge against both early market crashes and late-in-life inflation and longevity risks. Underpinning these dynamic models is a profound philosophical divide in institutional retirement theory: the probability-based approach versus the safety-first approach. The probability-based school evaluates retirement viability through Monte Carlo simulations. This involves running a proposed portfolio allocation and withdrawal rate through thousands of randomized historical return sequences to establish a statistical probability of success. If a plan achieves a 90% survival rate across all simulated trials, it is deemed viable. Conversely, the safety-first school, championed by researchers like Wade Pfau, views retirement through the lens of liability-driven investing. This theory segments retirement spending into a strict hierarchy: essential needs, a contingency fund, discretionary expenses, and a legacy fund. The safety-first axiom dictates that essential, non-negotiable living expenses must never be subject to market probability. They must be matched perfectly with guaranteed income floors. For the early retiree lacking a traditional pension or immediate access to Social Security, this requires the strategic use of ultra-long-term bond ladders or deferred annuities. Annuities are utilized specifically to capture mortality credits, the actuarial redistribution of capital from those who die early to those who live long. Only once the absolute baseline of essential needs is secured can the remaining assets be subjected to the volatility inherent in modern portfolio theory. A fundamental mechanical constraint of early retirement is the severe mismatch between asset location and biological age. Much of an individual's accumulated wealth is sequestered in tax-advantaged accounts like traditional IRAs and 401ks, which levy a draconian 10% penalty on distributions taken prior to age 59.5. Escaping this liquidity trap requires exploiting highly specific provisions within the Internal Revenue Code. Two primary mechanisms exist for this temporal arbitrage: the Roth conversion ladder and Section 72 TT, substantially equal periodic payments, SEPP. The Roth conversion ladder involves a multi-year strategy of systematically converting pre-tax traditional, IRA funds into a post-tax Roth IRA. The investor pays standard income tax on the conversion amount in the year the transfer occurs. Following a strict 5-year legal seasoning period, the converted principal can be withdrawn entirely penalty-free, regardless of the investor's age. This creates a rolling ladder of accessible capital. The fundamental limitation, however, is the 5-year liquidity gap. An individual retiring at age 40 must possess sufficient capital in standard taxable brokerage accounts to fund their life entirely from ages 40 to 45 before the first rung of the Roth ladder matures. When taxable bridge accounts are insufficient, the institutional solution is Section 72(t) SEPP. This IRS provision allows an individual to access pre-tax retirement accounts early, completely bypassing the 10% penalty, provided they take a series of mathematically rigid annual distributions. The IRS permits 3 approved calculation methods: the required minimum distribution, RMD method, the fixed amortization method, and the fixed annuity method. The RMD method calculates the withdrawal by dividing the account balance by the taxpayer's remaining life expectancy, resulting in payments that fluctuate annually. The amortization and annuity methods yield fixed, unchanging annual payments based on interest rates and mortality tables. The critical caveat of the 72T strategy is its absolute inflexibility. Once a SEPP plan is initiated, it must be maintained without any modification for a minimum of 5 years or until the individual reaches age 59 and a half, whichever is longer. For example, if an individual initiates a SEPP at age 45, they are legally bound to that exact withdrawal schedule for 14.5 years. If the individual decides to return to the workforce, attempts to alter the payment amount, or adds new funds to the account, the plan is considered busted. Consequently, the IRS retroactively applies the 10% early withdrawal penalty to all prior withdrawals taken under the plan, alongside applicable interest, triggering a catastrophic tax liability. Therefore, Section 72 IET is a tool of surgical precision, utilized to create immediate bridge income, but requiring total and unyielding commitment to the early retirement trajectory. To contextualize these highly theoretical mechanics, it is necessary to examine historical market data and institutional behavior through specific chronological case studies. When analyzing sequence of returns risk and the corrosive power of inflation, economic historians frequently contrast the retirement cohorts of 1968 and 1982. An individual retiring in December 1968 faced arguably the most hostile economic environment of the 20th century for a decumulating portfolio. The subsequent decade was defined by stagflation, a toxic macroeconomic blend of stagnant economic growth and rampant, persistent inflation. The Consumer Price Index, CPI, spiked relentlessly, measuring 4.2% in 1968, 5.5% in 1969, and accelerating to 11.0% by 1974. Even as the decade closed, inflation surged to 11.3% in 1979 and peaked at an astonishing 13.5% in 1980. Concurrently, the stock market suffered severe contractions, notably enduring a devastating 25.9% decline in 1974. The deleterious impact of this exact sequence meant that a 1968 retiree could only safely withdraw an initial 4% of their portfolio without risking total depletion over a 30-year horizon. Conversely, an individual retiring in August 1982 stood at the precipice of a historic multi-decade bull market, accompanied by structurally declining interest rates and plummeting inflation. Retrospective analysis indicates that the 1982 retiree's portfolio could have supported an astonishing initial withdrawal rate of 11.6%, nearly 3 times the safe withdrawal rate of the 1968 cohort. However, focusing solely on this percentage gap masks a profound second-order insight regarding the accumulation phase. Retirees do not spend percentages, they spend nominal dollars. If both the 1968 and 1982 individuals exhibited identical savings behavior, investing exactly $1,000 per month for the 40 years prior to their respective retirements, their ending balances would be vastly different. The 1968 retiree accumulated their wealth during the massive post-World War II economic boom, arriving at retirement with a portfolio balance of roughly $2 million. The 1982 retiree, whose accumulation phase dragged heavily through the dismal stagflationary 1970s, arrived at retirement with only $800,000. Applying the respective safe withdrawal rates to their actual nominal balances reveals a striking paradox. The 1968 retiree, restricted to a 4% withdrawal rate on a $2 million balance, could safely spend $80,000 annually, approximately $6,600 per month. The 1982 retiree, utilizing an 11.6% withdrawal rate on an $800,000 balance, could safely spend $92,800 annually, approximately $7,800 per month. The overwhelming 300% relative advantage of the 1982 sequence of returns is largely erased by the sheer volume of nominal wealth the 1968 retiree accumulated during their preceding boom. This dynamic perfectly illustrates the nest egg theory. Historical periods that enforce the lowest safe withdrawal rates inevitably follow prolonged bull markets that organically produce bloated, highly appreciated portfolio balances, thereby cushioning the blow of the poor sequence. While individual early retirees actively manage their guardrails, the mechanics of decumulation for the broader public are increasingly outsourced to massive institutional target date funds, TDFs. These funds automatically adjust their asset allocation, the glide path, shifting systematically from equities to fixed income as the target retirement date approaches. Analyzing the competing strategies of the two largest asset managers, Vanguard and BlackRock, reveals contrasting institutional philosophies on managing market volatility and sequence risk. Vanguard dominates the sector, controlling an estimated $1.8 trillion in mutual fund and collective investment trust assets, representing a staggering 37.5% of the entire $4.8 trillion TDF market. Their approach is brutally minimalist, utilizing exactly 4 broadly diversified index funds to capture global equities and fixed income, entirely devoid of active management overlays, tactical allocation shifts, or private equity sleeves. To manage volatility effectively without introducing the drag of excessive transaction costs, Vanguard employs highly specific threshold-based rebalancing algorithms. Historically, Vanguard rebalanced its portfolios back to their target allocations whenever asset classes drifted 200 basis points, BPS, from their intended weight. Recently, Vanguard optimized this architecture by establishing a new destination threshold of 175 basis points. In practice, this means that instead of allowing a portfolio to drift wildly before executing a massive, costly rebalance, the algorithm executes smaller surgical trades during periods of severe market turbulence, significantly reducing transaction friction and preserving participant capital. Conversely, BlackRock, representing the third largest TDF manager with over $611 billion in assets, has observed the widespread undercapitalization of the average American retirement, where median savings hover alarmingly near $955, and opted for a vastly more aggressive posture. Recognizing that traditional fixed income allocations may fail to generate sufficient absolute growth to bridge this massive savings deficit, BlackRock has actively re-engineered their glide paths to increase equity risk exposure for older participants nearing decumulation. This represents a high-stakes institutional bet, attempting to outrun the threat of longevity risk by voluntarily absorbing higher sequence of returns risk. Simultaneously, institutions are experimenting with volatility management funds, VMFEs, integrated directly into TDFEs. A VMF operates similarly to a stable value fund, utilizing an underlying portfolio of equities and fixed income wrapped in an insurance contract. This insurance contract provides downside protection against portfolio losses, enabling the fund to utilize accounting techniques to amortize the underlying portfolio's returns over an extended time frame, synthetically reducing volatility exposure for the retiree transitioning into the decumulation phase. When the microeconomic pursuit of early retirement, frequently branded under the FIRE movement, scales from isolated individual actions to a macroeconomic phenomenon, it fundamentally alters the structure of the global economy. A successful early retirement is, by definition, the permanent withdrawal of human capital from the aggregate labor market. During the COVID-19 pandemic, this phenomenon played out on a massive, accelerated scale, triggering what economists termed the Great Retirement Boom. Federal Reserve research indicates that the sharp drop in aggregate labor force participation was disproportionately driven by individuals aged 55 and older permanently exiting the workforce, Actuarial estimates suggest that altering retirement behaviors accounted for over 57% of this participation decline among older demographics, equating to nearly 1.7 million missing older workers. The macroeconomic consequences of this capital flight are severe and multidimensional. First, a shrinking labor force acts as a persistent, structural headwind to gross domestic product, GDP growth. Unless this deficit is entirely offset by massive, unprecedented surges in technological productivity or artificial intelligence, fewer aggregate hours worked mathematically constrains economic output. Second, this structural labor shortage fuels structural inflation. During the Great Resignation of 2021 and 2022, record numbers of workers voluntarily quit their jobs. The relationship between job mobility, the quit rate, and inflation is deeply embedded in economic models. As the labor pool shrinks due to early retirements, firms must engage in fierce wage competition to attract candidates or retain their remaining talent. The necessity to offer substantial pay raises drives up core operating costs, which are inevitably passed to the consumer through higher prices. This dynamic effectively steepens the Phillips curve, the historical inverse relationship between unemployment and inflation. Ironically, the widespread pursuit of early retirement generates the exact inflationary pressures that threaten the safe withdrawal rates of the retirees themselves. Furthermore, the mechanics of generating portfolio yield to fund these early withdrawals have evolved due to the phenomenon of secular stagnation. Heavily analyzed by former Federal Reserve Chairman Ben Bernanke, secular stagnation posits a global savings glut, where an excess of desired saving over desired capital investment globally exerts persistent, structural downward pressure on interest rates. When central banks implement accommodative monetary policies, traditional bond yields compress, starving early retirees of organic portfolio income. To counter this yield starvation, wealth portfolios are increasingly shifting toward alternative assets, specifically private credit. Private credit involves direct lending to non-publicly traded businesses by massive private funds, entirely bypassing regulated commercial banks. These instruments capture an illiquidity premium, offering higher absolute yields in exchange for locking up capital. Sophisticated early retirees are adopting a barbell strategy, balancing highly liquid, low-cost equity ETFs on one end of the portfolio with high-yielding, illiquid private credit funds on the other. A 2020 executive order further accelerated this structural shift by directing the Department of Labor to clarify fiduciary rules under ERISA, paving the way for unregulated private credit and alternative assets to be integrated directly into retail 401(k) retirement plans. The architecture of retiring decades early is vastly more complex than the rudimentary act of saving a portion of one's income and passively holding index funds. It is an intricate, multidimensional chess match executed against the backdrop of the global economy. An individual must aggressively capitalize their human capital, circumvent the devastating mathematics of sequence of returns risk through the disciplined application of dynamic guardrails, navigate the penalizing labyrinth of the tax code via Section 72 AT, and extract yield from a macro environment suffering from secular stagnation. To retire early is to successfully execute the ultimate financial metamorphosis, transforming from a provider of labor into an autonomous allocator of capital, entirely decoupled from the cyclical dictates of the industrial complex.